Good afternoon, everybody. As always, it's indeed our greatest pleasure to welcome you to our monthly Be Smart webinar series. We are here to educate our customers, entrepreneurs on what they can do to empower their businesses. So today we have a very special speaker who will be talking about business financial planning. As an entrepreneur, running a small business can be exhilarating, can be overwhelming all at once. It's tempting to devote the lion's share onto developing your products, developing your service, hiring the right people, and finding customers. However, it's important to carve out some time to tend to your financial health of your company by developing your plan that is taking your business into unforeseen challenges. It's similar to how in an aeroplane, you're always recommended to attach your own oxygen mask before helping others. So you cannot fulfill the needs of your customers or empower your employees, and then suddenly you find yourself in a liquidity crisis. So we'll have Annie Chungwa. Get your pen and notebook ready. Annie Chungwa, she's a business and financial consultant. She's also a CPA, Kenya. She's worked in the entrepreneurship space for about 5 years in several industries, helping organizations and individuals to organize and prioritize their needs as well as financial goals. She runs a management consultant firm called AK Strategy and Consulting. And has a bachelor in degree in economics. She has served in several boards, such as the Association of Startup SME Enablers of Kenya. She's also the president and Rotary Club Kikuyu, which is a global community for volunteers. Therefore, without much further ado, we welcome you, Anne.
Thank you so much, Richard. Thank you. Thank you for doing me the honors. And I would love to welcome everybody to this lovely afternoon. My name, as been mentioned, my name is Annie Chungwa, and I'm looking forward to having a very exciting time. Entrepreneurs, as you have heard, I've worked in this space with entrepreneurs. Still, they have made me look younger. I've been in the industry for 10 years, but interacting with them and so far loving it. So today we're just going to talk about finances, not so much about figures, but the theory around the figures and the theory around how can we live a financially healthy life. I would welcome all of us to the chat button. That's the only way we can interact. So put on your comments there, put on your shout out, put on your questions, and I'm going to address this at the end of the session. We'll have a Q&A session. But please put on the cap of, I don't want to turn you to become an accountant. That's not my essence. I just want to give you the reasoning behind how can we become financially healthy through financial planning. Fellow entrepreneurs, a lot of us went into business, and we went into business with the thought either we were motivated, we were passionate about it, it was accidental, we were coming out from employment, and we went into a business thinking that things will be easy. That's the notion that things will be easy. But what I have displayed on the screen is a typical day of an entrepreneur. A typical day of an entrepreneur that revolves around, I'm very excited today. Money has come in today. The next day I meet you, you say it's hard. Business is hard. I don't have finances. Debtors are on my case. 2 weeks later, you meet Anne again and you tell her, things are stabilized. Are looking better, and I am so loving it. The next day, yes, even the energy becomes better. You are up early and you are ready to go and deliver a service and provide a solution. The next day, you say, I am messed up. Career on my case. I can't pay bills. I have not paid. Even the business, the last time that they paid me, I can't even remember when business paid me. You say, I think I'm going bankrupt. I think I need to go back into employment. Fellow business owner, this is a typical life of an entrepreneur. But that life is not that gloomy, because a lot of us have found ourselves in a rat race. And what we do is that we wake up very early in the morning. We really wake up early and we work hard and we have the finances. But at the end of the month, when you talk to your accountant, there is no money at the bank. Completely, you ask them. But we were so busy. You had bills to pay. Among them, remember, you were not paid as a business owner, but you had bills. People had put a tag on the money that you earned during the month. You had a lifestyle, you had a family to maintain. You need to save. And then what happens? You end up borrowing to sustain that lifestyle. And it becomes a cycle throughout. And we find ourselves in what we call a rat race. Every time we are firefighting, trying to get enough money so that we can meet our obligation as and when they fall due. Now, as we do that, the good thing is that we can surely come out of this thing. It just requires knowledge, it just requires being practical, and it also requires taking action. And I do love that you have joined in our webinar today, because you're going to get the knowledge and you're going to apply. And hopefully 2 weeks down the line, you'll have a different story to tell. Now, the question now begs then, how do I get out of this rat race? How do I pay my obligation as and when they fall due? How do I get out of debt? Now, I would like us to do a very simple exercise. Remember, I said you will make it on the chat button. And the question I would like to pose and ask all of us, are we financially healthy? Remember the last day you went to the hospital, the doctor tried to do a triage on you. They took the temperature, they took the height, they took the weight. How financially healthy are you? And as we do that, we'll do using a very simple exercise. Let's make it interactive. If you look at your personal finance back then, the question to ask, what strategy did you deploy then? Were you saving? Were you still on debt? Were you paying bills as and when they fall due? Did you have what we call a budget? What strategy did you deploy then for you to be at that state? Now look at your finances right now, either personal or business finances. How are they? Please take a reflection. How are they? The question to ask you then, what strategy are you going to employ currently to get yourself from that situation? It could be positive, it could be negative. What strategy are you going to deploy to get yourself out of that situation or even make the situation better? Now let's look at 5 years ahead. How will this be? With the kind of lifestyle, with the kind of firefighting that we are doing, how will your personal and business finances be looking far ahead? Probably 5 years, 3 years down the line. Now, using the strategies that you have deployed, remember we did our annual budget, did our goals, began the year. How likely are you to achieve those financial goals when it comes to business finances and personal finances? That is food for thought. It's a very good exercise. Please jot it down. You can do it at your free time. Reflect and see how financially stable or healthy am I. Now, if you are to ask yourself, am I financially healthy? Am I able to meet my bills as and when they fall dues? If I met you and I ask you, Richard, how much are you worth? Do you have money to pay your bills? The question will be, I am struggling. Very well, you're struggling, but can you document for me and tell me what things do you own that have value? Fellow business owners, what if you sat down with a pen and paper? What asset, we call an asset, what are the things that have value and they are all under your name? Now flip it on the other side. How much do you owe third parties? Customer X is calling, landlord XY is calling. Have you tabulated all that liability, the money that you owe third party? Have you put it down on a dashboard and every day you are looking at it? Now, if you listed all your assets and all your liabilities, and then you did a very simple calculation, subtracted all that you have, less all that you owe your third party, that determines whether you're financially sustainable or healthy. And that's what we call your personal worth. A lot of us will find probably we are on negative. What does that mean? That we do owe a lot of money to third parties. That the little that we have is not even ours. A lot of people have attached their interest to the little that we have. A few of us could be on the flip. We could be having a positive. And what does that mean? You have been deploying proper strategy for you to replicate and do it better and better and grow your worth. Now, when we are still discussing about our financial health, looking at how much do we owe, how much do we owe third party, it's all about financial planning. How you plan the little or the much that you have. And a very quick definition of financial planning is looking into the future, bringing that future into the present, and living a lifestyle or taking actions that will help you achieve that future. So you look at the future, you'll be like, I owe all this amount of money, put it down, bring it forward and say, how do I start clearing all this debt? I would like to enlarge my business, bring it further. How much capital do I require? And start implementing strategies to help you get to that level. Now, as you do that, let me assure you, you get out of what we call rat racing. You get your freedom back. There's nothing as bad as when you are, everything that you do, you work hard, you have so many people attach their interest to that. You don't have your freedom. Remember, even it costs your family, but as you plan, you protect your family from any eventuality, any financial burden. You're really going to protect your family from it. As you do that, you're also going to monitor your spending because you're very wise. You're like, this was not attached towards my financial planning. It will help me, it will not help me get my freedom. I cannot spend on that. So you have what we call a monitoring tool, the budgeting. It also gives you an opportunity to even evaluate, am I able to pay all these expenses? Can I plan for my tax? Can I plan for my suppliers? Can I plan for my landlord in time? And how do I pay them? That's the essence of planning. Now that you understand what is planning and the benefit that it gives you, and now that you understand whether you're financially healthy or not, as you undertake to plan, I always say it's a very simple thing. Don't complicate it, either at a personal level but at a business level. It begins by first establishing, what financial goal do I want to? I would like to grow my business. I would like to get out of debt. I would like to increase my salary because the company has not been paying me. So I would love to have them pay me in 2020. That would be your goal. Now, sit back and look at current. What is my current financial situation? What does it say? And remember, that's the evaluation that we have talked about. List all your debtors down. List them with name and list them with the amount. This is I owe her this amount of money. List them down. Now, as you do that, analyze some critical data so that you start identifying where are these shortfalls or what can I do to get out of this shortfall. And in a short while, we're going to look at those kind of data that you need to analyze. Then thereafter, create very simple customized solution. Remember, financial planning is very customized. I cannot give you a plug and play. It's very different. So customize a solution that will help suit you and live a financially free life. And at the end of it all, you must take action. Don't put that document in the shelf. You must take action and then have somebody help you to become your accountability partner. You keep on reviewing that plan every now and then. After 3 months, after 6 months, review and see how am I doing in regards to what I have set out to do. Now let's look at, remember we said after you document your current situation, what data must I look at? What information must I get to help me get out of my rat racing kind of life? This is what we call the financial metrics. As a business owner, I would encourage you, let this become your Bible. Every day that you open your business, every day that you are sitting down with the finance team, there are some critical measures. You cannot delegate some of these things. There are some responsibilities that you delegate, but when it comes to your financial data, you cannot delegate. You must sit down with a pen and paper and look at what does the number tell me. Now, some of those metrics are metrics to do with revenue. How much are you making in a month? As a business owner, how much are you making in a month? That money that you have made, have you sold cash or have you sold on credit? it is important you distinguish the two. How much came in as cash? Because a lot of us, what we do, we give a cover-up figure. I did sales of 10 million. 10 million, you cannot differentiate how much is cash and how much is credit. Analyze, it's for you to analyze every now and then. For me to make a sales of 10 million, how much did I spend? How much did I spend? Which were the expenses that I had to spend for me to get this kind of income? Remember, expenses can either be fixed expenses or variable. We look at it later on. It is upon you as a business owner to keep an eye on what we call your break-even point. What do I mean? At any one situation, when you are running a business, you began by putting in your capital. Put in your capital, and then later on you started getting what we call some either returns. There's a point in business where the amount of money that you invested was equivalent to the amount of money that you paid. So literally you were not making any profit, but you were still in business, you were surviving. Neither were you making a profit or neither were you making a loss, but you were still in business. That's the break-even point. So as a business owner, it's upon you to put an eye on how much sales must I make every month to comfortably pay all the bills. That's what we call your break-even point in sales or in unit. And this you must communicate to the team and tell them that every day if we don't make a sale, every day if you don't talk to a customer, every day if you don't get out there and close a deal, potentially in a month, we are supposed to have this amount of money, but every day that you don't do that, it slowly pushes us to adding a loss and also getting into debt. Working capital is stock level, creditors level, debtors level, and your cash at bank. Those are the figures that you must look at every day to get into it. How much money do we have in bank? How much money do we owe third parties? How much money are we expecting to collect? How much money do we have in terms of stock? You must get that figure every day and analyze it. The other critical thing is your budget. I don't know how many of us have put their budget for the year, but it's important to sit down and create your budget for the year. How much sales do we anticipate to make in a year? Beyond documenting a budget, it's upon you to monitor and evaluate. How are we faring? We had said in the month of January, probably you have said you're making 5 million. Have we made the 5 million? What were the challenges? Why were we not able to make the 5 million? What have we learned so that in February we are going to change? The other metrics that you must look at is the burnout rate. We will look at it and expound later. Your cash runaway, how much time do you have to operate before you get out of business, or even debtors, or we call you in bankrupt. How much period do you need to operate? And then customer acquisition, customer lifetime value, and customer retention. Please remember, as a business owner, you must have an eye on your revenue, expenses, your break-even point, how much you need to sell to remain in business, your financial ratios around profitability, liquidity, efficiency, and leverage, your budget, your working capital cycle, your cash burnout, your cash runaway, and the cost of getting a customer versus the cost of losing a customer. Let me pick a few of them we look at. Let's look at the financial ratios. If I ask you, when you look at your audited accounts or your draft accounts that were done last year, what was your profit margin? How many of us had a look at it and said, my profit margin was 30%, 60%, 90%? How did you interpret that figure? Now, as a business owner, it's upon you to look at your profitability in relation to your expenses. Because a lot of us, and you'll find a lot of business model or a lot of business, they're not profitable because the amount of money that they spend is more than the amount of profit that they report. And that brings in the element of inefficiency. There's a lot of inefficiency. Cash probably is stolen. There are no controls. But for you, if you analyze your profitability level, You still think you're still in business. Let's look at the other ratio, liquidity. As a business owner, what does liquidity mean to you? Now, when you look at your financials, and this is a must, you ask from your accountant. If you have an accountant, please go back and ask them, I would like to look at my financials. They will be like, what are you coming from? Because you look like you understand some of these things. Liquidity. Now, if you are supposed to pay your debts, your short-term debts or obligation, your rent, your salary, your suppliers, are you able to pay them in a timely manner? Probably the answer is yes or no. But you can be able to have a look at your finances in advance and take critical measures to help you get out of this if you analyzed your liquidity level. It's upon you sitting down every month with your finance, your accountant, and telling them, like to analyze how liquid are we? If we are supposed to pay debts in a timely manner, how much money do we require? You need to have that at your fingertips, so that every time you look at the cash is there is a cash shortage, you remember that you're not able to pay your debt in time. The other one, especially if you're in manufacturing, it's a question of efficiency. We call them the efficiency ratios. It's the ability to deploy your resources. And what resources do you have in your capital, your assets to produce an income? And this is where your return on investment becomes very critical. Remember, I don't want you to grab some of these things. We are looking at the reasoning behind and how you can interpret some of these financials when you get hold of them. And that's why you find a lot of institutions ask you, go give me your audited accounts. What are they looking for? They do look at your liquidity. So you're going to approach Springboard and they will tell you, give me your finances. They're going to look at how liquid are you? Are you able to service a loan that you're going to give you? And remember, you can even arrest some of these things even before you approach them. In essence, because you have sat down with a pen and paper. So by the time you are approaching them, you tell them, I'm very liquid, my cash flow is okay. If you give me a loan of 5 million, I'm able to pay that loan. It becomes very easy for you to read and interpret some of these things. Now, the other one is an issue around efficiency. What do I mean by efficiency? Leverage. Leverage represents how is your business able to utilize? Are you utilizing borrowed money, or are you reinventing, what we call plowing back your profit? Now, if I looked at your capital structure as a consultant, I will be able to tell that your business is running on debt. Just looking at your capital structure, some of these things, just looking at it, and I'll tell you that your business is not financially healthy. Now, as a business owner, you must keep an eye on your leverage level. How much are we operating that is borrowed? How much are we using to operate or to fuel our operations that is ours, our cash that we have really reinvested? Let's not spend so much on time. For us, it's just a quick brief in terms of what you cut. Now, the next one was the burn rate. And that a picture there shows of cash burning. So we do burn a lot of cash for us to get revenue. Now, every company must spend before you get. But as a business owner, you must keep an eye on what are we spending. And that's what we call your burn rate. Please document every month, how much must we pay? Look at fixed cost. These are costs that whether you made a sales or you didn't make a sales, you must incur them. Put them aside. Look at the variable cost. Variable costs are the ones that keep on varying depending on your operations. Now, it is necessary for you to have a look at the burnout rate, because it tells you how much money do I have to spend each month before I make a sale. Now, if you look back at your bank account and probably you have a few shillings, that will quickly waken you and say, we must do a lot of business development. We must go out and lock sales out there because there's no cash. Because the rate at which we are burning cash is not equivalent to the rate at which we are getting the money. So push your sales team, push yourself if you're the person who does the business development to ensure that your burnout rate is equivalent to the rate at which you're getting the revenues. The other critical thing that you must look at is the runaway. And this was very pronounced, especially during the COVID season. A lot of businesses were not prepared. They didn't know, how long am I going to survive? How long can I survive with the little cash that I have, because sales had reduced? Now, the cash runway allows a business owner to have a top overview of how many months can I operate? Should everything remain constant? How many months can I operate before I close, or before even I look for third party to finance my business? It is important for you to understand. You have 3 months to run and then you close, or 3 months to run before you look for what we call external financing. It is also critical, the runaway, it's critical because it clicks at the back of your mind. If I have 2 months to operate, then you push your team and say, can we analyze? We sold on credit, who has not paid? Can we start collecting all the cash that is out there so that you can have what we call a safe landing? The other critical thing that you must look at as a business is what we call your customer acquisition cost. Remember, all this is around financial planning. These are metrics that will help you to plan your finances right. What do I mean by customer acquisition cost? Now, there's the cost that you spend as a business owner to get a customer. If I asked you, do you know how much it costs to lock that one customer? Do you know, in terms of monetary wise, do you know how much it costs? A lot of us don't even have that at the fingertip. That it costs 200 shillings to lock a customer. A lot of us don't have that figure. But it is important for you to document all those marketing costs and understand, for me to get one customer, it cost me this much. Now, what do you do with that figure? You must compare that figure, the customer cost acquisition. You must compare that with what we call the customer lifetime value. What do I mean by the customer lifetime value? That's the amount, it depends on the value that you are giving the customer. A customer has walked into Springboard. The customer has said, I'll need this amount of money. How much time do you have with that customer? Do they come repeated customer? Now, that's what we call the average revenue, or the average value that you create to the customer. Remember, the customer will stick with you as long as you create value. Now, if I'm using a very good example, if you walked, all of us, if the customers of Springboard, we walked to Springboard, and assuming that Springboard, they had sent their marketing and it costed them 2,000 to lock and to become their customer. Because they need to do the sales, the marketing, the talking, the all that. And then Anne comes in and gets a loan, and then Anne just get one loan. Upon pay, I leave. If you analyze that cost, the amount of time and revenue that Anne has generated versus the cost that I spent acquiring Anne, if the cost of acquisition is higher than the cost of having that customer, you are running a business that is not sustainable. So at any one time as a business owner, yours is to evaluate what is the cost of getting a customer versus the cost of having this customer and that now makes you become very creative. That makes you give what we call customer service so that you can have the customer locked, because you understand the cost of getting a customer is very high. The other critical thing that you must every day have a paper and pen to look at is what we call your cash flow. How is your cash flow management, or how is your cash cycle? Now, if you're in service, your cash cycle becomes very short because it's cash, you deliver, you invoice, you get money. Now, if you're somebody who is in product or manufacturing, your cash cycle becomes a bit prolonged, because it begins from buying the stock, putting the stock in the house, conversion of that stock. As you convert the stock, you sell. As you sell, the customer delays to pay you, and then it takes another 30 days, you collect. So you can see if you're in manufacturing, your cycle is a bit prolonged. If you're in service, your cycle is a bit shorter. But what we are saying is, for us, we need to understand what is our cycle when it comes to collecting cash. Now, when you look at your cash flow cycle, we always say cash is king. Cash is what drives our operation. And a lot of people have interest on our cash. We have our employees. we have our suppliers, we have our landlord, we have the government. Now, as a business owner, you must sit down, especially if you're in manufacturing, you must sit down and analyze 2 times what we call the supplier time and the creditor's time. What do I mean by supplier's time? You go, talk to your supplier, they give you goods. When they give you goods, probably they'll give you goods and say you can pay within 30 days. That's what we call the supplier time. Now you bring the goods into your business, put the goods in the store, and then you start selling the goods. All of them might not go at the same time, so you might start selling in piecemeal. Now the customer comes, buys the good, and the customer probably they will not pay on cash. And the customer tells you, I'll pay within 90 days. So look at, for you to collect money, you have a cycle of 90 days. Now the supplier comes, and the supplier after 30 days is knocking and saying, I want my money because I give you 30 days. Now what happens? And you have not collected money from the customer. You end up either looking for external financing to pay the supplier so that next time he can give you the good as you wait for the 90 days to collect from the customer. Now, as a business owner, it's necessary for you to shorten what we call your customers' days. It is necessary to shorten your customers' days and prolong your suppliers' days. Now, how do you do that? It's just about relationship. It's just about how do you negotiate. It's just a question of how do you negotiate with your supplier. And a lot of us during COVID season, we found ourselves negotiating with our suppliers, with our landlord, and asking them, can I prolong my days to pay? So that for you, you can have enough days to collect with the customers. Now, the biggest challenge that we have with a lot of business owners is around our cash receivable, or what we call our customers' days. How we have structured how we collect our cash is the biggest hindrance towards our cash flow. You find that you don't invoice on time. A lot of us, we are so good to giving a service, but we forget to invoice. You find some of us, when we invoice, the invoice is very inaccurate. And I do love the finance department. Finance department, my friend, they capitalize on that. What happened to my money? We looked at your invoice, how come to party a bank account? That's another prolonged period. We looked at the invoice, it had not stated the branch. Dear business owner, I would urge you, please sit down and analyze. How is your invoice structured? How does your invoice, a typical invoice, how does it look like? Because a lot of your cash challenges are around your invoicing. That's a discussion for another day. Now that you understand what are some of the metrics that I must keep an eye on, let's look at what are some of the things that have been affecting my cash flow. That every time it's a rat race, I'm not able to get out of this, I don't have money at the end of it. We've talked about the day of business. Depending whether you're manufacturing, you require more capital. If you're a service, you require less capital. And what does that mean? If you are not manufacturing and you require more capital, then you must keep your eye on your working capital cycle. At the scale of operation, a lot of us are operating at large scale. What does that mean? That every time you must have cash. Every time you must have money to allow you to operate. Look at your scale of operation. Are you operating at a small scale? Are you operating at a large scale? That will define how much capital you require. We also have business cycle. Business cycle, these are cycles that affect our businesses. We have boom periods. For certain businesses during Corona, it was boom. You required working capital. So as a business owner, how do you plan for this boom cycle? You're going into election. There are a lot of people whose businesses probably are going to boom. Have you prepared? Do you have enough capital to allow you to service some of these things? Look at some cycles. Sometimes we are also on a depression. Those are seasons that you don't have more capital. And what does that tell you as a business owner? Then what do I do? I do capital that I have. Can I invest it so that by the time I prepare for a boom, I have the cash with me? Look at your production cycle, especially if you're manufacturing. If it takes long to convert your good, you get your stock, there's a conversion. The conversion, the good have to stay in the store. You have to release the customer, analyze your production cycle. And this is where a lot of inefficiency is. If you're a manufacturing business owner, please look at your operations, your processes, your systems, because probably you could be saving a lot around your cycle. You have looked at how much credit you give your customers. Are you very conservative when it comes to credit? If you're very conservative, you're somebody who does not give credit, that means you require less working capital, because a lot of customers will pay upfront. If you're somebody who gives so much leeway when it comes to credit, you must have a lot of money to service, because customer A will keep on coming and asking for more. And then look at your operational efficiency, look at the controls. What controls do you have? Controls around your process, around your revenue, around your customer care. What controls do you have? How effective or how efficient are they? And as we wind up, so that we open for question and answer. Now that you understand the metrics that you must have, that you must keep an eye on, we must work towards having a positive cash flow, because it allows us to meet our short-term and our long-term obligation. On the other side, if your cash flows are negative, it will compel you to keep on borrowing. It will compel you borrow also, and you're not able to get out of that debt. Borrowing is good for growth, but you can do your cash flow. You borrow and repay. So borrowing can be a good measure to finance your growth. But if you borrow, you don't pay, and your cash flow are negative, you'll be in that quagmire. Now, then the question then begs, how do I maintain a positive cash flow? Now that I understand the metrics, understand my working cash cycle, and what affects my cycle, how do I maintain a positive cash flow? Remember, all this is geared towards our financial planning. How have you been putting records? A lot of us, I ask you, how is your recording? We are poor when it comes to record keeping. Not only even record keeping, timely record keeping. We also, when it comes to building our financial statement. If I challenge you, when was the last time you took your financial statement? You read and interpreted them. This is a critical thing that can help you maintain a positive cash flow. Do you budget? Do you stick to your budget? How is your business development initiative? A lot of us complain there is no money, I don't have money, that's why I'm in debt. How is your business development initiative? Have you sat down with your team this year? Have you said this is our target? Have you rolled out this our strategy towards increasing our sales? We talked about reducing the inventory conversion. You sell quickly, you process quickly by eliminating all. Now, some of us, when you look at your invoice, how is your invoice structure? You get a deposit for those who are in service or product, and the deposit should be more than 50%. Believe you me, have a habit of asking 50% of deposit before you begin a service. If you're somebody who is in service, can you structure your invoicing around what we call milestone based? I'm delivering a service, I have delivered up to this milestone, bill them, let them pay. Let them not tell you that I'll pay you at the end of the project, because you require your cash flow. Use that period for what we call your cash collection period, so that you quicken your cash collection. And the simplest way to reduce your cash collection period is look at your invoicing. How do you regularly follow up your outstanding amount? Now, this must be your everyday thing. Every day you get to the office, ask what we call the aging report. Ask your accountant, give me the report. I would like to know how much money is out there. And the aging report tells you, Anne owes you 30K, which is it's due. She has overstayed 30 days. Richard owes you 100K, it has overstayed 60 days. And the essence of this, it allows you to have a good snapshot of how long will it stay before you collect your cash. It's also important to consider, especially right now, cash is in terms of our flexibility, in terms of business. Can you give a discount for an immediate payment? If a customer is to pay immediately, can you factor that and say, I can give you a discount? It sounds, let me tell you, this is some of the things that works magic. If you go to a shop and they tell you, I'm selling it at 100K, but if you buy it right now, I'll give you 5% discount. A lot of us say, I would want it. Can you start considering, how do I bring discount for immediate payment? For customers who pay late, please do not be very conservative by not charging a penalty. Tell them if you did pay within 30 days, the invoice attract a penalty. It sounds very punitive, but it's a way of encouraging your customer to pay upfront. It's a way of also encouraging your customer to pay very soon to avoid delaying with money. We talked about negotiating with your suppliers and prolong that period. And also asking for deposit or what we call retainer. A very good customer is a customer who tells you, I'll put you on retainer, especially if you need service. I'll put you in retainer for the next 4 months. That's what we call assured cash flow. For the next 4 months, I know I have 50K that is coming, and you can easily maneuver your way out. Monitor your inventory. Please, if you're somebody who is in product or manufacturing, stop holding a lot of stock. You already have dead stock. That is stock that is costing you. Why don't you deploy a system that is called just in time? A customer has ordered for goods. Why don't you get the just-in-time method? Because you already have a rapport with your suppliers. A lot of us are still using what we call the first in, last in inventory. Let's look at efficiency when it comes to our production. Implement systems and structures, and match your customer period and the customer payment times, timely and correct invoicing. I cannot overemphasize on that. Then take advantage of what we call seasonal promotional sales. How many of us have gone into a shop and we have discount? It's discounted. You tend to buy. Why don't you, if you look at your cash flow and you say, hey, my cash flows are not looking nice, why don't you introduce, we are having a seasonal promotion. You're going to Valentine. Why don't you say we are doing seasonal promotion? If you're doing cakes, you're doing whatever product you're doing, why don't you sell them and say you have seasonal? This are what we call excitement. The customer buys, they buy in cash, and you end up having what we call your cash. Minimize your interest and your late fee on borrowed money. If you're having a loan, if there's a way you can minimize this, what we call the late fee payments, they attract an interest, and they attract an interest that is going to eat onto your cash flow. Look away at in terms of timely payment of your borrowed amount so that you avoid some of these penalties. Quickly, let us look at budgeting. I will not look at what is the definition. We already know what is budgeting, but for me, to emphasize the importance of budgeting towards financial planning. Have you sat down with your team? Because remember, if your team does not align and you're doing all this by yourself, you will kill yourself. Now, the good things about a budget, it's communicate at first hand. We want to make 50 million this year. These are the strategies that you're going to deploy. Employees will be motivated and they will run towards implementing that budget. Now, the rules when it comes to budgeting, there's some critical rules when it comes to budgeting that you must observe. This is what we call the 50-30 rule. What does that mean? That of any money that you have as a business owner, first 20% goes to saving. Whether you have paid anything else, it goes towards your debt payment, retirement, and emergency funds. That's 20%. Now, the other 50% now goes towards what we call the needs. You have a lifestyle, you have a family. What are those needs that operational you must fulfill? You must pay bills, all of those grocery, whatever. Those are what we call your needs. And the other is now the wants. You can do away with it. So as a business owner, for you, this is on a personal level, but as a business owner, the rule also applies, the 50-30 rule. What does that mean? 20% is what you secure towards paying your credit cards, paying your loans, paying your emergency funds. 50% will go to your fixed cost. Remember, these are costs that we talked about. You must incur whether you make a sale or not. 50% of your budget must go to your fixed cost. The other 30% will go towards your daily operation expenses. These are expenses around daily your valuable cost. So remember, the rule is the same. Whether it's at a personal level, we have 50 to saving to the needs, 30 to the wants. As a business, 50 to your saving goals because the business must save. 50 goes to your fixed expenses, and 30 goes to your variable as a business. And the last steps, what are some of the steps that you really need to look at? And I'm sure probably we have not made a budget. These are very simple. Set your goal for the year. Determine how much income you anticipate to get in the year. Budget 20 goes to your savings. Budget 50 goes to your fixed. Document those fixed costs. Put them down with a figure. Budget 20 variable. Record all those amounts, and then you constantly keep on reviewing your what we call your budget. You monitor and you review, and you keep on tracking. This is a very simple tool that can help you in terms of budgeting. There are quite a number, very simple. Mine is to please log in, download them, and make use of them. And let this become your dashboard. Put it on top. Let me having a look at it every day, every day. If you'd like to reach us, those are our contacts, and I would like to give back to Richard for Q&A.
Oh, thank you very much, Anne. It has been so enlightening. As we go to the Q&A, kindly go to the chats, give us your questions and any comments. I think one of my takeaways today has been a lot about budgeting, the 50-30-20 rule. It's something that we use it personally, but also for businesses, it's important to have that. We've learned about even the break-even points, about running away of money, burnout rate of your cash flows. So let's all adhere to this. I think it's been very enlightening. We have all become business financial managers from today. So kindly go to the chats, give us your questions. One of the things also you've seen is that planning for the future planning is the future brought into present so that you can do something about it now. That's my takeaway today. I think we've all seen how you can be firefighting when you receive money and your cash flow is running low. You tend to get to firefighting and you're paying all the expenses, the debts you've been having. So I think it's always important to plan your financial properly. SMEs and right now you get yourself overwhelmed when it comes to cash flows. So this is the right time to have this conversation. In January, have you asked yourself how much sales have you done to get to this? Have you met your targets for January? I think it's only that's something also to analyze as we have this webinar, and now plan what are the challenges that didn't make you meet those targets. Plan it now, February, take away those challenges and see what actions to do about it. That was very nice. So we've been having comments, people talking about coming from Kiambu, from Thika Road, Anastasia saying it's very financial awakening. So we thank you so much, Anne. I think time is running out. There's a question from Jane Esther Karugu. Explain more on the easiest way to get out of debt when they've choked the business, more so when you're paying more than making. That's a very good question, Jane. So Anne, over to you.
Yes, thank Jane for being candid and asking her, what's the simplest way of getting out of debt? It begins by, first of all, have you documented how much do you owe people? Have you written it down? Write and put the amount. Put the amount. After that, it begins by looking at which are some of the easiest loans that I can pay off. There are others which are 20K, 50K, 100K. So rank them from the lowest to the highest. So list them, rank them from the lowest to the highest. Start servicing, especially the loans which require little amount of money. That's what we call now, we start calling debt consolidation. If you sum up all your loans, especially the ones which have small loans, I'm giving a small example. If they all sum up to 500K, you could wake up and walk to a financier and say, I'm looking for a loan. That's what we call debt consolidation, because it gives you freedom. If 100 people are calling you because of 10,000, 50,000, 60,000, it's better if when it is one person calling you because of 500,000. So it first frees 100 calls because you don't know which one do I pick, or type it. Consolidate your debt. The next other step is look at your business, the cash flow. There's some money that you can save within your cash flow, because even if business is we're on a go slow, we don't have a lot of money. look at the efficiencies and the processes around your business. So the question is, when you're paying more than you're making, and I'm sure a lot of us here are paying more than we are making, you document, reconcile those debts, but also sit down with the financials. Talk to them and give them a payment plan. They always ask, what's the payment plan? What flexibility can we give? The only challenge is that we fear and we never approach and we never have a discussion. Have a discussion with them and restructure.
That was a very nice answer. I think we've all been seeing how we get also statements. Always make sure on a daily you analyze your statements so that you know what your statements are, what kind of issues, cash flows is going. Also, Joe is saying about good insights and reminder on to be on your toes in our daily dealings. Very nice. I think it's always important to keep check on what you're spending. Let's not be firefighting all the time. Let's not be in a rat race. I think this is a year of being prosperous. 2022 is a year of being prosperous. So let's make sure to plan ourselves financially. Then there's a question from Faith. I think this will be the last question before we close. Faith says, on matters personal finance, 50-30-20 rule, where does impulse buy fall into?
We talked about 20% if it's on a personal finance, 20% goes into your savings, 50% goes into what we call your needs, your basic needs, 30% goes into your wants. So impulse buy is a want, put it at 30%.
Just before you close, Richard, I had a comment. And you've dealt with a lot of business owners, entrepreneurs, SMEs in your work as a consultant. I'm finding this aspect, as has been commented in the chat by one customer about daily dealings, that we often make the mistake of not looking daily. We look at the end of the month at the finances, but you seem to be telling us to be looking daily. So are we to be looking daily, or we look at the end of the month at what the situation looks like and make a plan? I'm struggling a bit with this daily story that you're telling us. Please share your insights on that one.
If you are running a business and you are running a business that is, you want it to be profitable, you must look on a daily basis. You must look at your cash bank. Every day you get to the office, you must look, how much money do I have in the cash? You must look at what we call your debtors report. How much money is out there every day? You must also ask your accountant, your suppliers report. How much are we supposed to pay out on a daily basis? And you monitor. If today they're supposed to pay 100,000, tomorrow you still find it's 100,000. That's why you're quickly able to rescue the situation before it gets out of hand. Because remember, a lot of us, you wait until end of month, or probably after 3 months, that's when you look at it. It's already too late. Yet you could have enough time to rescue, sit down and negotiate with the suppliers because of the daily observation of the financial metrics.
Thank you so much, Anne. I believe we have some tools that can help you track your expenses. So whenever you spend and expense, you can be putting in the tool, how much you've spent, and keep track on that. Give yourself 10 minutes to analyze how much you've spent, how much you've got during the day. I think that will really help, as you've said, to keep track. So thank you so much, Anne, for your time. This has been an informative discussion about business financial planning. Now, Springboard Capital, we are a lending institution. We lend to all your finance needs, which include business capital, which you've talked about just now. And you've talked about working capital, import duty as well, purchasing assets, and many more. So why Springboard Capital? We are very customer friendly. We structure our solutions to cater for your needs. We give you flexible repayment periods. We are here to empower you and fund your dreams. Therefore, without taking much time, and you filled us with a very full plate this lunch hour. It's time to say goodbye. So see you next time. Have a good afternoon, everybody. Thank you for joining us. Goodbye.